Don't have time to pick individual stocks? Here are 3 of the best ETFs crushing it this year in 2025. First off, low-fee index ETFs like VOO, aka the Vanguard S&P 500 ETF, QQQ, aka the Invesco QQQ Trust, Series 1, and SCHD, aka the Schwab US Dividend ETF. If you don't feel like picking individual stocks, these are great options because they have a very low expense ratio, meaning they're cheap to own. They also track an index, which means they have a very diversified portfolio. You're not putting all your eggs in one basket. For example, VOO has an expense ratio of 0.03%, meaning if you have $10,000 invested, you only pay $3 per year to own the ETF. With QQQ, it's 0.2% or $20 per year on a $10,000 investment. And with SCHD, it's 0.06% or $6 per year on a $10,000 investment. Not only are these some of the cheapest ETFs out there, but they also have a pretty good track record. For example, VOO has an 8.48% average annual return over the past 10 years. QQQ has an 18.26% average annual return over the past 10 years. And SCHD has a 12.97% average annual return over the past 10 years. So not only are these ETFs some of the best in terms of price, but they also have a great track record. Now, there's nothing wrong with picking individual stocks, but if you're a beginner investor who doesn't have the time or knowledge to pick individual stocks, then ETFs are a great option. Another set of ETFs that are crushing it this year are thematic ETFs. These are ETFs that focus on a specific theme, such as AI, EV, or green energy. An example of an AI ETF is the Global X Robotics and AI ETF. This ETF tracks the Index X Robotics and AI Thematic Index. It invests in companies that are involved in the development or utilization of artificial intelligence, such as NVIDIA, Tesla, and Microsoft. The fund has an expense ratio of 0.68% and a 5-year return of 16.98%. Next up is an EV ETF. I recommend the iShares Electric Vehicle Global Fund. This ETF tracks the S&P Global Electric Vehicle Index. It includes companies involved in the electric vehicle industry, including auto manufacturers, suppliers, and infrastructure providers. The fund has an expense ratio of 0.40% and a 5-year return of 17.22%. And finally, let's look at a green energy ETF. A good option is the Invesco Solar ETF. It tracks the S&P Thematic Index, Global X US Solar Index. It holds stocks of companies in the solar energy industry, such as Enphase Energy, Solar Edge, and Array Technologies. The fund has an expense ratio of 0.40% and a 5-year return of 15.53%. Thematic ETFs can be a good option for investors who want to invest in a specific trend or theme. However, it's important to note that thematic ETFs are relatively new and may be more volatile than traditional ETFs. Alright, so what do you actually get when you buy an ETF? Well, you get a piece of all the stocks within that ETF. For example, if you buy 1 share of VOO, you'll own a tiny piece of all 500 stocks within the S&P 500. This leads us to our next point. ETFs offer instant diversification. With just one investment, you can instantly diversify your portfolio across hundreds or even thousands of stocks. This can be a great benefit for beginner investors who want to reduce their risk exposure without having to invest in individual stocks. In fact, studies have shown that ETFs tend to have lower maximum drawdowns than mutual funds and individual stocks, meaning they can help you ride out market volatility with less emotional stress. Lastly, ETFs are usually quite tax efficient. They generate less taxable events like capital gains distributions compared to actively managed mutual funds. This can help you keep more of your investment returns in your pocket. Here's a visual of how an ETF has performed compared to the S&P 500. As you can see, the ETF has experienced more growth than the S&P 500 since its inception in 2012. This is likely due to the fact that the ETF is a low-cost, passively managed fund that tracks the entire stock market, whereas the S&P 500 only includes large-cap U.S. stocks. If you're looking for a simple, low-cost way to invest in the stock market, then ETFs are a great option. With just one investment, you can instantly diversify your portfolio and ride out market volatility with less stress. Plus, you'll pay less taxes on your investment returns.